Hello and welcome to episode 435 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, how are you doing?
I'm good. I'm in a very positive mindset. So those of you who listen to the previous episodes and have seen me on YouTube in the last week or so, I've had a heavily bandaged hand after an operation. So that's improving. Hopefully I'll have the stitches out in the next couple of days. And then when I do the next series of videos for Money to the Masses, then I won't have a heavily bandaged hand. So that's positive news. So hopefully I'm on the mend. And the other thing that's really positive this week is we've had some really good feedback. And as I always say at the beginning of the shows, please do send in feedback because it is incredibly motivating to not just me, but the team as well. So we had Hazel, who has been a bit of a regular in recent weeks, sending in feedback from the other side of the world while on her travels. I'll just mention her quickly because if you've been on socials this week, our Instagram had some footage of whales that she had swum with, and that was fantastic with audio as well. So do go and see if you can find out on our Instagram profile. And just quickly, another person I want to give a shout out to is Hassan, who wrote in about the content that we produced around the budgeting apps, particularly Money Dashboard and the alternative of Money Hub. And so the feedback from Hassan was that he found, exactly like me, the pros and cons of Money Hub, and that was his choice in terms of a Money Dashboard replacement. So that was good to get that feedback. And also thank you to those people who commented on our YouTube video, which we put up online this week as well with your own views. And you've got another piece of feedback that we're going to read out before we kick on with the rest of the show.
That's right. And it was lovely to hear from George, who got in touch to say he's been listening to the podcast for quite a while now. He's an avid listener, gave us some really nice feedback, which was touching. We shared that with the team. He said on a related note, through the podcast, he's been inspired to start a side hustle around rugby that is now starting to bring in some considerable second income. So he was interested in what he could do in terms of the tax side of that things and asked for a bit more feedback, which we might cover in future shows.
Yeah, he asked also, had we covered it in the past? So I'm trawling through to see what we have covered in 400 plus episodes. It's quite difficult to remember. So if we haven't done it, then we will do it, because I think it's quite a nice theme anyway going forward. Maybe we'll do a series of podcasts around that particular topic. So thank you for that feedback. That was incredibly motivating. I'm going to now tell you what's going to be on this week's show. There's going to be 3 pieces. We're going to be a bit lighter this week, I think, because we've been quite heavy with content the last couple of weeks, although you have given us some great feedback on that content. So the first piece on the podcast is in relation to one particular investment platform that has reduced its costs, but it is significant because it marks probably a movement that we're going to see in investment markets. So Andy's going to be talking about that, as he is our guru on all things related to investment platform pricing. Then I'm going to do a piece about Vanguard alternatives. Now, there are lots of people who are almost cult-like about the Vanguard Lifestrategy funds. Now, I'm going to talk about alternatives to those funds. And in particular, one of the Vanguard Lifestrategy funds is based upon a piece of research that I've been carrying out for 80/20 investor members. But there comes a point where if you have a sizable sum of money in one of those funds, if it's at the core of your portfolio, for example, you might want something else that works a bit like that, particularly in relation to the Financial Services Compensation Scheme. I'll explain more when we get to that piece. And the final part of the show, Andy's going to be doing a scam piece.
Yeah, we're just going to do a quick rundown of the latest scams that have been out there. There's been a rise in certain scams, and which actually, I'll give them a mention, do a regular piece where they update the latest scams. We'll cover a few of those just to make sure that people don't fall foul of them.
Yeah, and just a little bit of admin. Next week, there won't be a podcast. I'll say it now because some people might not listen to the very end of the podcast. There won't be one next week because we're having a week off to be with our families. It's half term, but we will be back the week after as normal. So jumping into the first piece on the podcast. Now, the news broke this week that Interactive Investor, they're known as II as well. You'll see that advertising on TV at the moment. They've just launched a new campaign with 2 little robot characters. So you'll see that probably, well, Andy actually saw it during the football the other day, which surprised him. But they have launched a new plan. So Interactive Investor is probably what it is the biggest fixed fee platform out there. So most platforms work by charging a percentage of the assets. So the percentage of your portfolio size as a administration fee. So Hargreaves, for example, charge a platform fee. It starts off at 0.45. Fidelity does a similar thing. And what tends to happen, these things are tiered. So the more money you have, you tend to pay a smaller fee. And of course, you've got the robo-advice propositions out there, things like Nutmeg, Money Farm. They all charge a fee as well. But Interactive Investor is the second largest platform in the UK. And they charge fixed fees, which makes them very attractive for people who are wealthy, because it gets to a certain size that the fee, when you apply it as a percentage of your portfolio, starts to become very small.
That's right. And so the news this week from Interactive Investor was interesting because it was about their SIP product. But if we rewind slightly, they did introduce a new, cheaper fixed fee model for their investment products just last year.
And the thing you've got to bear in mind with Interactive Investor, if you look at a review, we've got reviews of all the platforms. We'll put links to them in the show notes, actually, so people can read what we say about them. So Interactive Investor, we used to say is a broad finger in the air when you go back a year or two, that you really got the benefits of that fixed fee pricing. It became cheaper than using a platform that charged a percentage fee, a percentage of your portfolio size. You got the benefits of that fixed fee when your portfolio got above about £50,000. So beyond there, then Interactive Investor became incredibly cheap, because the bigger your portfolio got, the charges didn't go up. And so we're talking about the platform fee here. We're not talking about the underlying fund fees, because universally they will be the same across the platforms. So II created the Investor Essentials plan because what that did is it gave the benefits of a fixed fee platform to investors with smaller portfolios, because obviously they want to attract some of the people down the bottom end who don't have as much money. And so to do that, they created almost like a light version of that subscription plan. So if you think about the subscriptions that are out there that we use in other parts of our life, you often see, whether it will be things like Netflix, Spotify, whatever they are, they tend to create light versions that people who maybe don't want all of the bells and whistles of that service can get a version slightly cheaper that is suitable for them. So they created that on the investment side, but they've now created something similar on the pension side.
That's right. So Interactive Investor have launched a light version of their SIP. So their standard plan was called the Pension Builder plan, and that would cost someone $12.99 per month as a subscription fee. But as we talked about, that meant that people would roughly have to have around about £50,000 in their pension pot to make that worthwhile when you compare it to platforms that charge a percentage fee. Well, they've launched their Pensions Essentials SIP plan now, priced at just $5.99 per month, which is £7 cheaper than the standard plan. And so that starts to bring the portfolio size down, to which the fixed fee model starts to become more attractive.
So that's the point of this piece of the podcast, because it's not an advert for Interactive Investor. What we're showing here is that the fixed fee model, which most people will dismiss until they've got a portfolio size of at least, say, £50,000, now that's much more accessible to people. It is worth looking at whether something like Interactive Investor can be cheaper for you. And in fact, Andy did the analysis and he looked at it across the board, and it is one of the cheapest ways to have a pension now, if you just want a pension in particular. So if you're going to open a pension, you're not worried about the stocks and shares ISA or a general investment account, you don't need those bolt-ons. Then if you're just going for a SIP purely, so don't forget, with this, you'll have access to a wide range of funds. It's not like, say, for example, Vanguard Investor, where you only have Vanguard funds. You can invest in all sorts of things, ETFs, investment trusts and unit trusts, and also direct shareholdings.
And actually, while we're talking about Vanguard, they are known for being very, very low cost. They charge just 0.15% as a platform fee. We've talked before about at which point the standard SIP plan becomes actually more cost effective if you use Interactive Investor. Well, this new SIP Lite version, the Pensions Essential plan, starts to actually mean that it's cheap to invest in Vanguard funds via Interactive Investor at a much lower price point. Now, there is a caveat to that because we haven't mentioned this yet, and I should just mention it. Once you invest in a SIP in this Pensions Essentials plan and you invest beyond £50,000, you get automatically moved up to the next subscription level, which is the $12.99 standard plan. So when I say it's cheaper at a certain point earlier, you have to be careful with the numbers because it will jump back up.
Yeah, and so we do the analysis on the website, and Andy will put links in the notes of this podcast. But the message really you should take away from this part is that when you're saving into pensions and you're choosing whatever it may be, for example, a robo-advice proposition, you may be with one of the other platforms that give you a wide access to investments of your choice, ETFs, investment trusts, unit trusts, and you might pick your own portfolio. Once you get to a certain size now, probably around about 30,000 or so, you should look at the cost saving that could happen if you look at some of these fixed price platforms such as Interactive Investor. It may not work for you. With regard to the Vanguard Lifestrategy funds, we've done the analysis again on that before. And if you are one of these people who loves life strategy, don't forget the Vanguard Lifestrategy 60% equity fund. I mean, I was looking at it earlier. It's 13.7 billion in size. It's the biggest fund within its sector, which is the mixed 40 to 85% share sector. Now, that is huge. So lots of people have it as a core holding in their portfolio. Broadly speaking, in a pension, once you get more than it's about £104,000, then Interactive Investor becomes a cheaper way to hold that in the long term because of the fixed fee model. And as Andy said, when you'll be on the higher charging plan for a SIP. But if you are looking just to invest via something like an ISA or general investment account, then on Interactive Investors price plans, then once you get around about £96,000, that's when it's cheaper to hold Vanguard Life Strategy funds with Interactive Investor rather than with Vanguard Investor, which is the name of the Vanguard platform, because Vanguard does itself cap its platform fee after a certain level. So there you go. That's a roundup of what's going on in the investment platform space. And it's important to bring it to the podcast listeners because people who may have had their platform for a long time won't necessarily realize that things have shifted quite considerably in the last year or two. And actually they can save themselves thousands of pounds a year, which will make potentially a big difference to their pension over the long term.
And so we mentioned Vanguard there, and it's a perfect segue into the next piece because Damien, you've been doing some research into some Vanguard Life Strategy funds for 80/20 members.
Yeah, so this is a snippet from that. Now, it's quite interesting, the piece we've just completed on platforms and when it becomes more cost effective to hold Vanguard Life Strategy funds elsewhere outside of the Vanguard Investor platform, because there are lots of people that have it as a core holding and they will slowly over time be increasing their exposure to that fund. Now, one thing to bear in mind is the Financial Services Compensation Scheme. So with the FSCS, you have to realise that when you invest via an investment platform, the protection applies to different things. So there can be, if the platform goes bust, something that they particularly do, but I'm focusing on what happens when the fund itself goes wrong. So let's say, for example, I'm talking about Vanguard here. So let's say something happened with Vanguard and it went completely to the wall, then what would happen to your money? Now, ordinarily under the Financial Services Compensation Scheme, what would happen? You'd be protected up to £85,000. Now, that protection is per firm, and so that is per person too. So if you had a pension and you had a whole load of Vanguard funds that, let's say it totaled £500,000, and if Vanguard went bust and there was a situation where you could make a claim under the Financial Services Compensation Scheme, then you would only be able to claim for a total of £85,000. And that would also be true even if all of those funds were held with different platforms. So that becomes an issue. So as you start to build up your pot and you one day might get beyond the £85,000 threshold, then you are exposing yourself to that potential that if something went wrong, then you won't be covered by the Financial Services Compensation Scheme. Now, that is true of any investment platform, and it may be people watching this and listening to this podcast thinking, blimey, Damien, you are a bit of a doom monger. But when you have stories like we've had this week with Metro Bank, I've lived through the period, I remember working in the city when the financial crisis occurred and when we had bank runs, and everybody was suddenly worried about the Financial Services Compensation Scheme. They didn't even think about it before that, what protections they have. People need to be aware that it exists, but then the problem that occurs when you start to commit all of your money to not just one fund, but it's one fund house. So given that Life Strategy is a very popular fund, and people might be sitting there building up sizable pots into that fund, that could be because their employers pay money in, or if they're self-employed, they'll be able to pay lump sums at the end of a year, for example, for tax efficiency, and that pot is building up. Then what can you do about that? Now, it raised the question that are there other funds alternatives to the Vanguard Lifestrategy that do essentially the same thing, because it is incredibly popular. It is almost cult-like. I will say to people, go and listen to podcast 378, where I talked about the downside of the Vanguard Lifestrategy funds, and I explained how they work, because they didn't perform very well in 2022, and that was a good highlight as to how they work. And so a lot of people learn about what they're actually invested in as a result. But let's say you do like them and you want to invest in an alternative that does the same thing. How do you even find one? Because there are thousands and thousands of funds out there. How do you go about looking for an alternative? And interestingly, I did this for 80/20 investor members, and I look at something called a correlation coefficient. So the mathematician in me gets excited by correlation coefficients. Very simply, it's a statistic that can be calculated. So you take two things, so it could be two funds, and you look at how their price moves over time, and if they move in lockstep, so when one moves up, the other does exactly the same way, then they have a correlation of 1. If they move in opposite directions at the same rate, then it's a -1 correlation coefficient. And if they're completely unconnected and they're doing things almost seemingly independent of one another, then it would be 0. And so you can find things that behave the same as something or completely differently, and you can use that to diversify portfolios. Now, the issue is it's quite difficult to calculate. I mean, I have tools that I use that I pay for that enable me to do this, but how would somebody who's listening to the podcast, who's now sitting there thinking, yeah, do you know what, this is a good point, I want to find another fund just like Vanguard that isn't run by Vanguard. So I want another life strategy fund that's the same allocation, 60% equity. That's what I'm going to use as my example today. I want to find another one. So one way of doing this is to go onto a website like TrustNet, and you can go and rank funds in a sector, for example, and you can decide what the table is going to look like. And I went on there and tried to find a way of doing a bit of scruffy research that could give me a similar result to what I was finding when I did the 80/20 investor piece. And I built a table, looked at the 5-year performance and ranked it by that. So from the best performers to the worst performers. And I therefore went and found the Vanguard Lifestrategy 60% equity fund. So it's the most popular fund in the mixed 40 to 85% share sector. So just because two funds end up having a similar performance over a 5-year period doesn't mean that they got there in the same way. It's like you arriving at the same destination doesn't mean you took the same route as somebody else. So it's important, therefore, to try and get a feel for they were doing things in the same way. Now, like I've mentioned, you won't be able to find the correlation coefficients because you have to calculate them. But what you can do is put in the 3-year performance and the 1-year performance on that table, and then look across and see if you can find funds that will be very close to the Vanguard fund that you're looking at because you've ranked it by the 5-year performance. Look at the ones a few above and a few below to see what the 3-year performance figures. Do they match or very close to the Vanguard Lifestrategy 60% fund? Then look at the 1-year performance. And what you do is you very quickly whittle down your shortlist to get to a couple of choices that you sit there and think, these seemingly had similar performance profiles over 1 year, 3 year and 5 years. Then if you go and chart them, because you can do that on things like TrustNet, but on your investment platform of choice, you can then chart them and see how they perform. Did they move in the same way? And incredibly, you can find funds that basically do exactly the same. Now, I'm going to give you one of them. This isn't a recommendation in any way, shape or form. It's just a product of some research to show you this is how you can do this stuff. Now, one thing I'm going to tell you before I give you the fund name is you will do that on the fund 40 to 85% share sector, and you'll come along with some answers. And I suggest before you click go, add in the other sector, which is the 20 to 60% share sector, which is the one that's a little bit more cautious, because in there is a fund that does pretty much the same thing as the Vanguard Lifestrategy 60% fund, but it has slightly less than 60% equity, so it's able to go into the lower or more cautious sector, which obviously you'd have missed that if I hadn't have told you. So go and find that sector, put that in your table as well. And then what you'll find is you'll very quickly find a fund called the Barclays Wealth Global Markets 3. Now, if you go and chart that, your jaw will hit the floor over 5 years, for example, because you'll see they pretty much are in lockstep. And when I charted it, the difference in performance is often fractions of a percentage point, or it's within 1 or 2 percentage points. Now, the fund is the Barclays Wealth Global Markets 3 fund, and that actually has a correlation coefficient of 0.98. over a 5-year period with that life strategy fund. So that shows you it is almost moving in lockstep. So you end up coming up with a similar result that I did in a much more mathematical way. So they are similar in that they hold lots of underlying trackers. So in the case of the Barclays fund, they're iShares. In the case of Vanguard, they're often Vanguard holdings, but they are slightly different in the things they invest in. So the Vanguard has a bit more exposure to UK equities, whereas the Barclays fund doesn't. And so there is a slight difference in performance, but it's very marginal. But if you look over 1 month, 6 month, 1 year, 3 year and 5 year time frames, as I make this podcast today, the Barclays fund actually outperformed the Vanguard fund on all of those time frames. And okay, sometimes we're talking a sort of less than a percentage point, but it just goes to show that there are alternatives out there if you want them that do the same thing. And so you can invest in something else and not fall foul of the FSCS limits. Of course, I'm not getting into the fact that if you've got a partner, you can split your investments with them. I'm talking about an individual here. Now, the other thing, when you're doing your research and you're trying to find out alternatives to something like a Vanguard Lifestrategy 60% fund or any fund that you really like, it doesn't have to be Vanguard. I'm picking on that one because it's one of the most popular funds out there. You do have to bear in mind that you're going to have to look at other unit trusts and OEICs because the FSCS protection applies to UK domiciled OEICs, OEICs, which are open-ended investment companies, and unit trusts. Now, interestingly, they don't necessarily apply to investment trusts or ETFs because if it's not domiciled in the UK, then you get the protection of the jurisdiction where something is domiciled. Now, I tried to confirm the fact that investment trusts weren't covered by the FSCS with the FSCS, and they are very unhelpful in that regard. What they do is say go and speak to the provider. So always, if you're looking for any investment fund of any kind, do speak with the providers to find out what the protections are. But if you look at a lot of the literature out there, because ETFs are effectively shares and investment trusts are shares in companies, then they operate in a slightly different way, and therefore the FSCS protection isn't universal. So what that means is if you're looking for an alternative to something like a unit trust, you need to find another unit trust and make sure it's domiciled in the UK, not Ireland, because it won't be covered. And of course, the FSCS doesn't cover individual shares or bonds anyway. So the message from this part of the podcast: be mindful of those limits that exist with the FSCS, but you can use performance tables if you're shrewd enough. Make sure you look in areas where you're not expecting, maybe other sectors, and you can find alternatives that probably do almost the same thing as a fund that you particularly like. Now, I've in this piece have just focused on funds that do the same thing in terms of their mixed assets. I'm not talking about going and creating a quasi version using other unit trusts that invest in UK equities, North American equities, because in theory you could probably build your own version of a life strategy fund if you look at the underlying asset allocation of a whole range of unit trusts and OEICs. I'm focusing on keeping it simple.
Okay, so let's finish off the podcast with just a quick piece on scams. We cover scams every so often on the podcast, and generally we do it if it's particularly newsworthy. Things have hit the news, they're prevalent scams that have been mentioned on social media, etc. So I'm going to run through a few of those now. So the first one I'm going to mention is Argos. There is a big scam at the moment around batteries, funnily enough. So there's an offer of 160 batteries for £3. It's hit social media. If something seems too good to be true, it usually is. So make sure that you're aware of that one. Basically, if you click on the link, they're going to take your details and you never know where that's going to end up. NatWest seems to always pop up, and a lot of banks, to be honest, Lloyds, HSBC, NatWest isn't the only one that suffers this, but there's a phishing email going around where there's an email impersonating NatWest, and it says something like, and it does vary depending on which version of this scam that you see, it says there's a major upgrade and modernisation program happening to their online banking, and you're required to fill in details to confirm your account. So NatWest has responded on this to say they would never do such an email, so just be mindful of that. And so again, that goes with any other bank. Just don't click on anything if they're sending you random stuff by email. We've seen quite a few more scams surrounding Bitcoin recently. Bitcoin was obviously quite big through the lockdown period, and then it went quiet again. One of the latest ones seems to focus on Jeremy Clarkson, explaining how he earned millions from home investing in Bitcoin. It isn't a laughing matter. Obviously, people have fallen foul of this, but Jeremy Clarkson seems a very strange celebrity to pick to endorse a product.
I think it just emphasizes that things don't have to be the most sophisticated to be believable. So people will just click on things. I mean, there's so many times that probably all of us have almost clicked on something because you thought it was interesting or relevant. So it's always best to be wary.
And so the last two I'm going to cover off is a Center Parks survey scam. So essentially you'll receive an email saying, can you please fill in this quick survey and you get a chance to win a holiday or whatever. Basically, it's just phishing for your details. And so make sure you don't fall foul of that. The general theme of those emails, and they do change depending on who gets them, is that you'll win a family break if you fill in all the details. But of course, what you're doing is you're handing over your personal information to a scammer. And another one just to be mindful of is the QR code scam. We did cover this in a previous podcast. It seemed to be centered more around sort of London hotspots, restaurants. People were effectively putting fake QR codes on existing QR codes in order to get you to fill in your details, and things like restaurants like Wagamama's and things where you pay by app. Just be mindful of that. That's still going on by all accounts, but now they've moved over and on to other areas such as car parks. So we've all been to a car park before, I'm sure, and we haven't got change, and the only way to do it is to download an app. And the quick way to do that is to scan the QR code on the car parking machine. Well, they're now being targeted, and so just be mindful and make sure that you are actually downloading what you think you're downloading. The best thing I think really is to note whichever car park you're in and the service provider, and go and find that in the app store yourself rather than scanning a QR code, because you never really know where that QR code is taking you.
Yeah, and one other that I just throw out there, it's just more of a generic warning, because a lot of these scams, they target things that they know people will more likely click on, and particularly periods like this where we've got a cost of living crisis, that people who are vulnerable or desperate, they may send out things like text messages that promise things like loans. And I saw an horrendous story of somebody who'd fallen foul of a scam whereby that was sent out with a link. They clicked on it and effectively the thing had downloaded not only their contact details from their phone, but also photos of them, and then used that to send fake images to people in their contacts. And you can imagine what those images were. So just be mindful of, like Andy said, if something is unsolicited, you didn't expect it, you didn't ask for it, and it also seems too good to be true, then don't click on it.
And so that's it. We're done for this week's podcast. If you want to get in touch with Damien, you can do so in the usual way. It's Damien@moneytothemasses.com. My email address is andy@moneytothemasses.com. If you want to give me any suggestions or ideas or feedback, they would always be welcome. Don't forget, please do review the podcast on your podcast app of choice. 5 stars is what we prefer, to be honest, and it really helps us to share the podcast to other people.
Yeah, and we've not given away any Money to the Masses mugs for a while. So if you've done something mug worthy or you want to give us some fantastic feedback, then please do so, because you could find yourself ending up the proud owner of a Money to the Masses mug.
And so that's it. We're done for this week. Until next time.
Until next time.